Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined the community for the first time, a massive welcome. We have a big episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We love speaking to Australian fund managers here, especially Australian fund managers that are taking their funds and bringing, investors from around the world and showing them what Australian fund managers can do. We're excited to understand how it is all happening. Jared Pohl, welcome to Equity Mates.
Thanks, guys. Really happy to be here.
So Jared is co-founder, partner and portfolio manager at ECP Asset Management, who are an Australian active fund manager, and we're going to talk all things investing philosophy, stock selection, and then finish with the case for Australia.
Yes.
Now, Jared, to kick things off, as always, we love to hear from our experts about your investing philosophy. So how would you define your investing philosophy?
Yeah, so, the company line, I probably should push to you guys, but I think maybe the origin story is that, it's not something that I was born and in the cot shaking, I want to be an investor. Most people probably say that. I came to it a bit later in life. So, I was lucky enough that my father, he was the founder of Hyperion. So there was a lot of dinner table conversations around investing and what's important. And it's a bit annoying actually, because I've always get measured against him, but, that's kind of, I've been able to step into my own now. But really, it comes down to growth for me and the sustainability of growth. And that's kind of what we do at ECP. And that whole philosophy just guides everything that we do. But I really had to push against him a fair bit to kind of find that. And I think as investors, you really need to figure out what kind of investor you are or what kind of person you are. Because if you try and I'm not a value investor. I'm not going to try and buy cigar butts. It's just not my personality. And, it's the same that we've had value guys in our team and they just don't work because they're just trying to get cheap things in, not necessarily like things that are structurally growing. So, yeah, if I had to sort of define it, it's companies that are in the growth phase of their life cycle. So there's that inflection point. And that doesn't necessarily mean companies that are growing earnings yet. They're just expanding their economic footprint. And you can be doing that through new revenue pools, taking share of customers, you can operating leverage in the business. All of those things is what you're trying to find, because those are the more likely ways that you can sustainably grow the value of that investment rather than, acquisition or ripping costs out or something like that.
Yeah, I love that. Sustainable growth. At ECP, you've got 6 key values. One of them is demystifying active investing. Yeah. And we're excited to get into this early in the conversation because active investing is probably a little bit unloved relative to its much more popular peer passive investing these days. Passive investing and index investing seems to be really having a moment. So can you make the case for active investing for us today?
Absolutely. That's what we're selling. It's
it's your job.
I get a lot of practice, but I think that, I've written a lot about it, and there's kind of 2 parts to the equation. There's the price side, which a lot of passive funds are looking at. So you talk a lot about factors, whether it's growth or quality or momentum. And then you've got this other thing, which is like value. They're probably the wrong terms to use because that's like an investment style, like value or growth or whatever. But let's just talk about idiosyncratic stock selection and then price action. And they're very distinct things. And the passive funds are more that side of the coin. And then what we're doing on active investing is like trying to find underlying value or idiosyncratic return. And the way you go about doing that's very different. But just to come back to your point around like demystifying this, it's kind of important, there's some very amazing fund managers that have been on this podcast and I listen to it. But the things have moved on in the last 20 years. And it used to be that a manager would come in and say like, look, we're just going to do everything for you. And what I mean by that is that they were managing currency risk and sector risk and all of these things, but they weren't actually able to articulate where they're taking risk on those dimensions and why. So at ECP, we're very clear we're taking idiosyncratic risk. And it's a bit harder to do in long-only investing. We can't sort of minimize some of the other risks in there using short positions or whatever. And there's reasons that we don't short. But what we're looking for is to say, like, look, we don't want to take risk along a currency dimension. That's not how we make money. We're experts at picking the right companies, the right business models in those industries, and then really seeing where they can be, like, longer term. And that has huge impacts for alpha generation, like structural alpha generation. And that's like real money you're taking from the market. Where on the passive side, it's just trading mean reversion, really. That's how I see it. Like, you've got, it's 10 times today and it should be 15. Like, why should it be 15? And quants, systematic strategies are way better at doing that than people are. So I think that side there's a place for it, but it's very different to what we're trying to do.
Now, the counter argument to on the active v passive side is just that a lot of active managers underperform the benchmark.
Yep.
Now, full credit to ECP, you don't. And I was surprised that wasn't actually part of your case for active management. But I think, for us as, retail investors who weren't in the industry and were trying to like learn from the outside looking in, the passive side of the debate has a really strong argument that a lot of active managers don't outperform. And who are we, as Bryce and I, as everyday people, to choose the right managers, to choose that, whatever it is, 15, 20% of managers that do consistently outperform.
Yeah.
So I guess our question for you is, what should we be looking for in a good manager? How do we find that, subsection of active managers that, do your side of the debate proud and do consistently outperform?
Okay, so I think for a retail audience, because I have a habit of getting a bit technical. So, the guys at work are like, make sure you dumb it down and just I get told that all the time. But I think the first thing is just find fund managers that sort of suit your personality. There's the value investors, there's long short, growth. Like if you're a naturally more optimistic person, growth's probably the way to go. So that's probably the starting point. But I really think when you're picking a fund manager, they've got to be able to articulate where they take risk, why, and how they get paid for it. That's the first thing. And if they can't articulate that, you might think you're buying a growth manager and there's these sort of value blips there, or they're very momentum driven. And a lot of growth investors are momentum investors. They kind of say they're growthy, but it's just earnings momentum or something like that. It's quite hard to do, unfortunately, to really pull apart the way that alpha is generated. But simply speaking, if they say they're going to do something and they're doing it, that's like a very good test. But the longest test is really, how do you perform in the long run? 10 years we've been, I think in our small cap products, like close to 10% alpha. It's like 9.5. And in our all cap product, it's in the Aussie product, it's like close to 5. And that's very long track records of consistent alpha generation. So that's also something to look at. But you've got to be able to understand what they're doing. And if you don't put your money with them.
What is the time frame that you suggest we should compare returns over? Like, what's the minimum baseline?
Yeah, I think it's kind of strategy dependent. So like value as a strategy for me is an interesting one, because I feel like it's a high velocity strategy. You get called away a lot. You might have Whitehaven Coal on 1 times earnings, but that's not going to be cheap forever. And you get called away from that position, and then you've got to find something else. Maybe there's a case to be made that's probably shorter term numbers for something like that, because they're trading on a P mean reversion, where in growth, it takes time for this stuff to happen. I mean, your guys' business, right? Your podcast has taken time to build.
Still growing.
And to the moon. Was it diamond hands?
And it's still a value play as well.
That's it, yeah.
And so something like growth takes time for this stuff to play out. And we've got positions that have been in the portfolio for 10 years that are still growing. That's why we think it's just easier. I don't have to do as much work. Like we find a company and we can sit with it for a while. Now we've got to really know it so we can position size in the right way. But it's something that, I think if you've got 3 to 5 years of data, like you can start to really assess, do these managers have structural skill or not? And there's a lot of ways people do it through Sharpe ratios and all these sorts of things. But to really get to the nuts and bolts of it, you've got to take out all the factor exposures. And so this is quite difficult. I mean, hey, maybe that's something you guys can start providing to, your listeners, right?
Yeah. Well, I mean, look, like we know that, there are plenty of people that do it, like Zenith, Longsec, Morningstar. So we wouldn't feign to say that we could match those guys. But it's like, what are they using to rate different funds that we sort of can replicate or
I don't know about the replication's quite tricky, because essentially what these guys are doing, like, hello Zenith, hello Lonsec, we've got our reviews coming up, so can we keep our ratings where they are. But they're basically taking your holdings and they're working out, do you have growth exposures? You say you're a growth manager, and there's certain things that they look for, like factors like, sales growth, earnings growth, or, is the P of the portfolio quite low? Then it's a value portfolio. So like if we were saying we're a growth manager and our portfolio P is lower than the market, it's kind of like, oh, hold on. Or you have like no free cash flow or something like that, and you're meant to be a value manager. There's some questions there. So they just look at quantitatively, is the data saying what you're saying in your philosophy? And really, if that stuff lines up, that's a good tick. But they really go into much more detail with like trading behavior and these sorts of things. So, they really run you through it. You got to open the kimono a couple of times a year, and I don't mind now, I'm getting used to it, but it's, it's worth it, because at the end investor, you've really got to be clear that you're getting what you're paying for.
Yeah. Well, I think there's some good things for retail investors to take away there. Is the manager investing the way they say they are? Long-term returns, or, 3-5+ year returns, and then we can look at those ratings from Lonsec and Zenith and stuff like that. So a few things for us to look at, but I guess we want to drill down on your how you manage your money, and you said there's sustainable growth. And I find the framing that you had there quite interesting, because I think in conventional wisdom in investing circles, growth managers are seen as more short-term, jumping from momentum play to momentum play, and value investors are seen as longer-term, sensible, somewhat boring investors. But, your framing earlier made a lot of sense, that value investors are often the ones that are having to move from position to position more quickly. And when you're talking about sustainable growth, those stories can play out over years or decades even. I guess let's start by talking about like what is sustainable growth. I assume quality is like the key buzzword there. So talk to us about what you're looking for and where you find it.
Yeah, so we're a little bit different in that most people will start with like valuation first and go, here's a commercial idea, let's work at it. We just work our way through systematically a bunch of business models that we think make sense, and then do a whole bunch of work to try and work out what characteristics of these businesses exist. In our mind, that like a good growth company that has the highest probability of positive returns is something that has like big markets to grow into. They have the right business model. For example, they understand what their internal drivers of competitive advantage are. That's not just saying that they've got supplier power or something like that. Those Porter's type analysis. It's saying like our brand is actually driving our competitive structure, so let's invest in that. In our case, there's 18 assertions that we work through, and we look for these characteristics. And if they exist, we go, okay, there's a really high probability that this is a growth company that's going to succeed. So that's our definition of quality. Quantitatively, that shows up in high returns on invested capital, good balance sheets, low accruals. So management aren't making adjustments to the P&L, et cetera, like to kind of hide issues in the book. So those sorts of things are the output of the work that we're doing, and they tend to systematically show up. Now, they don't need to be there immediately. Like there's some companies that we've invested in really early, like Megaport or whatever, that are not showing those things just yet, but they will get there. But they're still very high quality franchises. So that's our starting point for quality, and it's more about the business. So really understand the business, what they're doing, and then the accounting should reflect that. Just like the Zeniths and Lonsec are checking our investment style, using our returns and holdings, we do the same with a company where we say, well, look, we think this is what's happening. We understand the business model should be exhibiting these characteristics, and then we look for it in the accounts. So like relevance and reliability of accounts is another measure of quality for us. Then valuation comes into it. Like growth and momentum tend to tie together. But as a fund, we have been kind of called like a contrarian growth, because we tend to be selling winners and buying losers. So we're super valuation sensitive. So we'll have our, call it 30 names that we like, and the expensive ones we just take capital away from, and like WiseTech, and we'll put it into something like Block at the moment, because it's super cheap and it's unbelievably high quality and it's growing. And so we'll just take that time premium and then let it play out. So yeah, quality is not about financial metrics as an input. That's the outputs you should look for, and it's the underlying business. So you've got to spend your time understanding that, the competitive structure, customers, suppliers, and so forth.
I want to bring this to life a bit more. So you've mentioned there you start with business models that you like, 18 assertions or characteristics. Like using some positions in your portfolio at the moment, can you perhaps talk through some of the business models that are attractive or some of those 18 characteristics?
I'll do something a bit different, like maybe on the global side. So because as an industry, it sort of demonstrates this. So payments is like an enormous industry globally, right? And that needs scale. So it tends to acquisitive type companies, and a lot of the traditional payments companies have all been acquisitive. But then you find companies like Wise, you may know Wise is listed in the UK, or Adyen, which is a payment processing business listed in Netherlands. These companies have a competitive edge because they've built their software stack from the ground up. And so they can drive cost lower. In the case of Wise, like they basically keep reinvesting their profits into lowering the cost for customers, and that drives volume. So, there are some tricks with this, but, effectively, like things you have to watch out with that business model is that, profit can only grow as fast as cost growth for a period of time while they keep driving costs down, or like the cost of the customer down. And then at a certain point, it'll start to tick up again. So a lot of like growthy guys will say, oh, well, they're going to just deflate the size of the market as they win share. But at a certain point, there's a limit to that and it'll turn. So, in that industry where it's acquisitive, like you can see that the business model that makes sense for someone like Wise is to be able to build it from front to back end themselves. And it takes time to get scale. But because of that, they've got an edge in a significant way. If you want to send pounds from, say, Brazil to London, you've got to go through like 4 or 5 banks to do that, but with Wise, it's immediate and it's much cheaper. So it's that sort of example. Megaport, I raised before, is a very different business model to traditional telcos. If you want to go and connect London to Sydney, traditionally you've got to go and talk to Telstra, and then Telstra's got to talk to AT&T or BT Telco, and then you end up having this connection that gets built over months, and it costs you probably like 10 grand a month. But with Megaport, they've built that all already, and then they're selling it on for like 60 seconds. You say, look, I want to connect these data centers together. So software business models tend to work better in our style of investment just because there's way more margin that they can play with. It's way more efficient. Not as much human capital. Or any of the portfolio companies we can sort of talk to if you want, and we can bring this alive a little bit more. Yeah, well, I think throughout this conversation, we'd love for you to share your names, and then by the end of the conversation, you can test us and see how much of your portfolio we can name. So how closely have we been listening? But you also mentioned earlier you had 18 assertions that you sort of used to sense check different things. Can you give us an example of one of those assertions, like what you mean there? Yeah, well, the starting one is that the market's big enough to support growth. So, and that's, for a growth investor, we sort of joke about it a lot. Like there's the typical, the TAM's enormous, I don't know, like someone wants to paint your fingernails or something. There's a lot of fingernails in the world. And if you can only get 1% of those fingernails, it's like the biggest. Like the classic startup pitch. If we get 1% of this market. 1%. And so that's the challenge, is really defining what a addressable market actually is. And healthcare is like the problem with healthcare all the time. Top down, amazing. Bottom up, really hard to do. So we spend a lot of time trying to work out, as a growth investor, what is the actual market that they can attack here and grow into, and what does that look like? Because it's really important for growth, like that ability to gain share and continually to gain share. Like Guzman, let's just bring it back to a real example. Like there's a big question mark around how many stores Guzman can have in Australia. The company says about 1,000. Our modelling at the moment is like 650. But there's a bit of room for us to improve that. So at 1,000, it's probably worth $50 today. If you believe they're going to get there, $60. But at 650, it's probably 30. So that they're very sensitive to these long-term TAM assumptions, and so you've got to get that really right. Now, you're not going to be perfect, but that's the first assertion. And the way that we think about assertions is not motivating case for something. I don't come in and bang the table and say, Guzman's the best business I've ever seen, I want it in. The way we operate is to say, like, look, we believe that this company is a really good investment opportunity. Let's go and prove up that there is a big addressable market, and that's true or false. Does the company understand its driver of its competitive advantage? And something like A2 Milk we used to own a while ago, they were very clear that it was their brand. That A2 Milk, they were the only ones that could use that brand. And they really invested in that brand. And that really drove that competitive advantage, particularly in China, when there was a lot of issues with, dairy intolerance and stuff, and it's caused by the A1 protein. So, they really pushed that home. And if companies understand that and they invest behind it, that there's a probability that skew of returns is positive. I can imagine there's nothing a company dislikes more than an investor coming in and saying, you don't understand your competitive advantage. But is there an example, and maybe you don't want to call out a particular company, but is there an example of a company that you think maybe use a historic one so it's not
as relevant, but like that a company just didn't understand their own competitive advantage?
Yeah, that's a hard question. I think maybe because the heuristic is there, we tend to find companies that are quite aware of this stuff, but they don't think about it in the same terms that we do. Because we're kind of analysing it, we probably give more weight to this. But I think inherently the companies kind of know, like if it's a CSL, it's plasma collection. They kind of get it, and they, but they're probably not as discreet about that particular thing. But there's a lot of companies out there which we look at and we just go, man, what is going on here? Like, let me sit on that. Like, I might just jump in and come back to you if I find in my mind where I'm like, oh, that company just doesn't really get it. But Australia's got pretty good companies here. It's a very competitive market, and the results of that, we have a duopolistic kind of market really here. But Australia in general, it punches above its weight in terms of quality of company. So a lot of the companies that are successful, at least on the boards, are pretty good. But if something pops up, I'll just interrupt you guys rudely.
Nice.
Well, we'll get to Australia in a second, but can you talk us through your portfolio construction approach? Because particularly in, growth-focused investors, you can get these stocks that really run and become quite dominant in the portfolio. So talk us through that, and perhaps also some common mistakes you see from growth-focused investors.
Maybe I'll also add some suggestions here, because portfolio construction in a benchmark relative sense is kind of easy. You just say, well, CBA is 10% of the index. I'm going to have 12 because I really think it's going to grow quicker than the market. But if you arrive from the moon and you build a portfolio, I just think that's the worst way to invest, because you're anchoring on market size rather than expected future growth. So we don't look at the benchmark at all with respect to portfolio construction. We come down and say, look, where's the highest return subject to risk, and we're going to allocate the most money there. The trade-offs being earlier stage companies tend to have bigger expected growth over time, but there's also bigger forecast error. So, Nuix at 60 cents, there's a lot of forecast error, but a huge amount of upside. On return alone, it should have been a 10% position, but risk-adjusted return, it was like a 3 for us. It's at $7 today, and it's probably a similar position size now because there's much more clarity around things. But with respect to portfolio construction, I think if you step back and you go, okay, first principles, how do I position size? If you have no information about future, but you just pick the business models, you like Nuix and Megaport, CSL, Block, equal weight your portfolio. That's the max diversified portfolio. It doesn't cost you anything. And if something's running ahead and something's falling behind, just keep reallocating towards that equally weighted portfolio and it'll perform really well. It is your max diversified portfolio. And you see that's why Seeds Venture does this. They just have it's $1 million.
Bang. Yeah.
And they just max diversify their portfolio. There's no prospect of future growth or if it's going to be a winner or loser. But if you want to improve on those returns, you've got to then think about, okay, what is Nuix going to outperform the rest of the portfolio? Yes, we should have a bigger weight in that. And then you've got to think about how does that translate to size. And that problem is not solvable yet. We've worked on it a lot and we do it pretty well. Our conviction weighted portfolio outperforms our equally weighted portfolio. But it really just comes down to, as professional investors, you've got a sense of what the asymmetries look like. So Nuix at 60 cents was just a laid out misère. I was probably the only person in the world talking about that stock. Everyone was I think I was in the press all the time. Anyway, it's paid off. But we did the work we had conviction in the thesis, and it was just totally oversold. So it just comes down to thinking about, Thinking in Bets is a really good book, by the way, if you haven't read that. And it's professional poker player thinking, that sort of way of thinking in terms of probabilistic thinking is really important for investing. So you've got a sense that the upside's really unlimited here and the downside's limited, then you should probably have a higher weight. So there's a shape you can think of in your mind. 2 years ago, growth investing when rates were really ramping, for us, the tailwinds were just enormous. The headwinds were enormous, but you knew that shape was flat to down in terms of interest rates, and that's starting to play out. So we're going to have these tailwinds now. But pre-2019, when rates were really low, for growth investing, you knew that rates were going to go up at some point. So you have to think, what does the shape look like? So, start with an equally weighted portfolio. And then if you have real conviction, however you get that, it could be valuation driven, it could be quality driven, then you can start to tweak your portfolio a little bit. But that's very difficult to do. There's a lot of sophisticated ways of doing that, which we try, and we're constantly improving that process. But
do you have any hard and fast rules around like number of positions in the portfolio or like minimum weight, maximum weight, stuff like that?
So for us, min weight's 1% and max weight's 10. That's a bit uncommon. Like there's some pretty spicy positions in the portfolio at like 10 and blocks close, right?
Yeah.
GQG was there a while ago and everyone hated that business. They were like, I don't know why, but it was awesome.
My theory is that a lot of people got burnt on Magellan and then weren't into a fund manager after that.
Yeah, because we own Magellan and we exited when they lost that their big mandate from St. James.
Yeah.
But like that was more of a thesis break, and that's a kind of really important point, right? So in growth investing, have your thesis and be very clear about your assumptions. Like what is driving this? And in the Magellan case, it was that they were selling this dream about in markets that are going down, we will outperform, but we won't underperform that badly in up markets, you know?
Yeah.
And St. James Place bulleted them exactly when they should have not bulleted them. And you're like, well, that was just nonsense. Like it was immediately the thesis was broken. Like the investors were not buying what Magellan was telling us they were buying, gone. And that business was then going to unravel quickly. You know, fund managers are great businesses to own on the way up and the way down. You don't want to be there just because of the scale, right, in terms of those business models. But, you know, we had then Magellan in the portfolio and everything that is like was going wrong with Magellan was going right for GQG. You know, they have a real alpha proposition. They have a distribution alpha proposition and they're acquiring FUM at a rapid rate. You know, everyone just was like, oh, it should just be trading on every other fund manager. No. You know, it had way higher growth, bigger opportunity. It should be on a massive multiple compared to the rest of these guys. And I think we were getting like a 10% earnings yield, dividend yield on that position as well. So, you know, we were getting paid to sit there and let everyone, you know, everyone was like too stressed to own it. And then it finally started to move, you know, and it's upgraded its earnings profile. So it's still cheap, but, you know, we have sold that position down. But yeah, be really clear on your thesis. If that breaks, exit. Like valuation, regardless of if it's cheap, if your thesis is broken, go.
Yeah.
I remember, I think we both owned Magellan
we did,
at that time. And we took it as when others are fearful, you be greedy. And I think we doubled down. Or I think you doubled down. Put a bit more in, but then it was very obvious that it was game.
Yeah, so, you know, that's kind of like a core difference between, I guess, us and other managers. Like Nuix, the thesis was the same. At 60 cents, it was just an absolute screaming buy in our view. Like when we already owned it, but we just kept allocating towards it. But like IDP Education is one of our biggest positions now. And that is just a structural growth story. It's unloved because of all the stuff we know about, you know, people are trying to stop visa applications coming through. There's limited numbers and there's a bit of uncertainty. But that business just keeps taking share. All the bad actors are going to be removed from those markets. And at some point, they're going to come out and be much stronger as a business. And, you know, when growth turns, it turns and you've got to be positioned for that. But our thesis has never broken. It's always been a market share story. Now, there's not issues with that business. There's some idiosyncratic market issues and it's a supply issue, not a demand issue. Like there's just demand through the roof, you know, for their services effectively. So we'll own that. And at some point it'll rectify. So as long as your thesis is playing out, then when people are like hating it, of course you should invest because that's when you're going to make real money. And all of the big alpha contributors to our portfolio over the last couple of years have been something like that. It was like GQG was unloved. Lavisa was unloved. Nuix was unloved. Megaport was unloved and then like too loved for a while and you're selling it and then you're back again. And that's where you've got to have your thesis and then the valuation side of it is where it comes in.
Let's turn to Australia. I think you've done a really good job of talking about some great Australian growth stories so far in this conversation. For a lot of investors, I guess in Australia and also outside of Australia, we are not loved. We are a market that's just boring banks and miners. You know, like there's a lot of stereotypes that I guess you've got to overcome when you're trying to convince people that Australia can be exciting. So you have a lot of focus on Aussie markets. So make the case for Australia, and I guess, you know, pretend that Bryce and I are asset consultants from like Middle Eastern sovereign wealth funds or US, you know, institutions. How do you sell Australia?
Well, I think for the underlying investors here, like let's ignore the big superannuation, you know, and a lot of these guys are my clients. So, you know, I'm not having a go at them, but they do have some regulatory requirements like your future, your super that mean they end up investing in a particular way. And there's a wall of money there that has to follow certain rules. It's got to be low tracking error, very index aware. And what you're starting to see is that there's disconnects happening in the smaller end of town. So, like CBA, it's like one of the most expensive banks in the world. There's no fundamental analyst says it's a buy. There's a couple of holds and a lot of sells, but it still keeps going up and up and up. But what it means is there's disconnects in the lower end of town where things like Block, for example, it's dual listed, but that's really cheap. Megaports, Nuix, like there's a lot of really great companies around in the growth space that are very high quality businesses that are competing on a world stage, have unique products, and the valuations sometimes can really open up that you can invest in them. And that's part of the issue with Australia is that people think it's just very expensive. You look at a WiseTech, it's an unbelievable asset. It's expensive on a global relative basis, but it's a very unique asset. Pro Medicus is another one, which is like a phenomenal business. We don't own it because it's so expensive, that people will generally shy away from that. But you can find really interesting opportunities that are very high quality at the right valuations here. If you're just patient, they'll come up.
Did you look at Zip when it was down and out?
Yeah, so we tend to pick who we think is the winner in an industry, and Afterpay pretty much won that. And we were in Afterpay very early, even through the COVID drawdown. That was a great opportunity at $8. I think Emma Fisher was on here and saying, I should have bought it. We did. Sorry, Emma, but we did. And, I think some of the issue there was like people were worried about the balance sheet, but the way that the mechanics of that balance sheet worked was that the less people that used Afterpay, the more equity that unlocked. So there wasn't any funding risk in that business at all. If you want, on our website, you can go and read the article that Damon wrote. It was like the 13th of March or something, 21. Yeah, so when we were looking at Zip and Afterpay, like the big difference between the two for us was that like Zip just seemed like another, financing business where Afterpay was something a bit novel in Australia, and that existed in other places around the world, paying for, but in Australia it was a very novel approach, and they just did a phenomenal job. Like the way that they scaled that business was great. So for us, it was an obvious play. Like where the scale, like the venture scale type returns were going to be was Afterpay, not necessarily Zip. And Zip are much better now, I think. They've closed down a lot of the kind of underperforming regions, and for us, we felt the winner was there, and we made our play.
Yeah.
And it was a pretty good play from $8 to what? It got over 100, didn't it? Yeah. Jeez. So, earlier in this conversation, you said you like to think in business models and what business models could work, and is the market big enough? When you think about Australia, are there any particular business models or like particular industries where you think we are particularly interesting as a market, or is it all just idiosyncratic and down to individual companies and individual opportunity sets?
Both are correct. So Australia's got a tendency to do pretty well in certain sectors, and as I said a few times, we're very competitive. Like you go to the local shops, like for a coffee or whatever, and the quality of the food's amazing. If you go and buy QSR, like Guzman, and there's a really, really high quality around Australia compared to a lot of other markets. And I think the market's big, but it's not huge. It's not like America where you can just make money and be average. Yeah. Like you've actually got to be quite good here.
Yeah.
But, healthcare Australia is fantastic. We've got, CSLs, and there's a lot of innovation there. But there are also really good technology stories that have come out of Australia. Mining, obviously, is a very, very good one. And the funds management industry, or the asset management industry as well. Like we're globally competitive there. But for us, it's very much opportunity by opportunity. So we'll look at any sector anywhere around and just try and find something that we think is very unique. If we can't find it, it's okay. There's certain sectors we just don't look at generally, but something might come along all of a sudden that goes, wow, this is something a bit different. And we feel like it can change the industry structure, or it can take share from competitors, and then we'll have a look at it. So that's kind of more of our focus, is stock by stock.
So Australia has some well-known, arguably expensive companies, many of which you've spoken about, REA, WiseTech. So to close today, Jared, is there a lesser-known company that you think will be joining the ranks of these, I guess, market darlings of the Australian growth?
Oh, man, it's a really hard one because we tend to own most of them. Like share performance aside, asset-wise, like Nuix has got a very interesting asset. So globally, they're the market leader in, it's called like processing, but basically they take unstructured data and they use it for discovery, litigation, and it can be moved into certain other areas like security, compliance, etc. And they're definitely the market leader in that processing. One of the risks people worry about is like, will generalized LLMs be able to do this stuff? Like you just dump a bunch of data in and you you get a result. But the difference between Nuix and that, for example, is that the LLMs are probabilistic. So you get a different answer a lot of the time, but you get exactly the same answer in your searches with Nuix. So it's used in legal cases and like big ones, the Royal Commission, the Panama Papers. Like there's a lot of places where it's been used. Now that business has had a lot of challenges in the last 2 years, but they're really getting on top of that. Now, we were a huge shareholder in that and we've trimmed our position, and it's not because we're negative on that opportunity, but the market's implying some pretty big growth numbers there. We just want to see that execution happen. But if Jonathan and the team can continue to deliver on what they believe is a good product and they can roll out their strategy, I think it's definitely got some potential. But for us, it's kind of meeting our expectations for now, but we need a little bit more evidence to prove up where it can get to. But unique asset-wise, I think it's a really good technology asset. Megaport, we've been a shareholder in for a very long time, and that's a very unique asset. It's like the biggest network as a service provider in the world. Again, there's been a few challenges there, but the new CEO, Michael's doing a fantastic job, and the market's a bit sour on it, so I think you can probably make some money there. We're a major shareholder now. But they've got to just execute again. And a lot of growth investing is about execution. Value guys will come in and say, look, it's cheap. It's 20% below what its value, like it's worth. We're going to own it. And that's their margin of safety. You'll probably talk about that a lot. But growth really needs quality and it needs execution because it's a longer duration strategy and you need the companies to execute like relentlessly on what they're doing. And if there's any slip up, they get punished for it.
On that was going to be our last question, but I'm going to slip one more in there because the conversation around execution, I think is worth following up on. You said there with Nuix, if Jonathan and the team can execute, and so much of these like high quality businesses, the sustainable growth businesses in Australia and around the world, are really driven by like a core group or one entrepreneur. Pro Medicus, it's Sam Hubbard. Megaport, it's Bevan Slattery. Like there are these people that had the idea and really drove it. When you're looking at a founder entrepreneur who's now listed their company and is trying to continue to grow it, like I know it's a little bit of pattern matching, like everyone's different and every opportunity set's different, but like what are you seeing that's consistent amongst them that like really gives you confidence that this could be something?
Yeah, so I think the biggest issue for investors when they're assessing this is like how do you determine what's good or what's bad? And founders tend to not care about anyone else really. They're like, this is what's best for the business, and they go after it. Professional management's very different. They come in and they want to maximize margin or profits, but generally it's because that's their incentive structure is to kind of how they're going to generate wealth through that. So, always look at the incentive structures. What does the remuneration package look like? Because you're going to get a pretty clear indication of what they're going to do. I mean, if it's, just EPS growth, they're going to go and acquire a whole bunch of stuff. In CSL's case, it was like return on invested capital. And that was a really great measure. They're sensible allocations of capital, and then they can start to acquire, equity in the business. But yeah, founders are definitely more worried about what's best for the business rather than themselves. And I don't think a lot of them are sort of money driven, like they're very mission driven. And that's a really good thing, but it can bend people out of shape a little bit. You've got to be a specific kind of person to work with a founder. There's nothing wrong with professional management at all, but then you've got to start thinking about the structures that kind of guide their decision making in the right way. But, Bevan's now stepped out of Megaport and this business has now got professional management. And if you look at, say, Michael, he's doing the right things. He's not really too worried about, oh man, I got to pump earnings here. He's just trying to get his go-to-market right, the product set right. And then it's really like let's sell it and make sure we can compete. And, they're all incentivized appropriately, but, it's a bit different to Bevan. Bevan has he's a prolific founder. He's just got a fantastic range of businesses there that he's been involved in. But, it's very different to Michael. But, as a professional manager, he's incentivized in the right way, but he is executing. So let's just sort of see how he goes.
Yeah.
Well, if you'd like more info on what Jared and the team are doing at ECP, head to ecpam.com. A number of funds there that you can invest in if they're right for you. But Jared, thank you so much for coming in. Absolute pleasure.
Yeah, thanks guys. It was a lot of fun.
Yeah, thanks Jared.
Great.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.